doesn't fascinate everyone, but we will try to keep it as interesting as possible throughout this 1 hour. Thank you very much. Sam, please proceed.
Thank you. So I think to kick us off is to give a little bit of context to where we find ourselves today. And that is to look at the corporate tax journey of the UAE very briefly. So we look back a couple of years to 2021. The UAE itself actually joined through the International Political Agreement, the OECD agreement on BEPS. Now, that sounds like something very long-winded and doesn't need a huge amount of explanation, but what it actually did is it started to set the foundation for putting in a corporate tax regime here in the UAE. Previous to this, there was a very, very limited regime in place, only applied to very, very specific businesses. However, on the 31st of January last year, it was the day after my birthday, so I remember it very well, the Ministry of Finance gave me a late birthday present with the announcement that there would be a federal corporate tax regime introduced in the UAE. And what it did is it released sort of a very bare bones announcement, some FAQs that set out some of the key aspects, and with more information to follow later. Middle of last year, we saw there was a public consultation document that was released. Again, put a little bit more meat on the bones, started expanding on what's going to happen with this regime. Then the big date, 9th of December last year, the law itself, the federal decree law, landed. Now, what we've actually seen since then is there's been significant development from that point onwards. The law itself was the basics. We've seen a number of cabinet decisions, ministerial decisions, other releases that have started to really add to that law and really start to fill in the gaps and really give us a bit more of a complete picture on what the UAE tax regime is going to look like. Now, the big date there is the 1st of June, and this is when the actual regime will apply from. Now, there's some specifics of how it will relate to your businesses, depending on your year end, and we'll go through that a little later, but it becomes effective from the 1st of June this year. Now, we said that some of the fundamental pillars of this law were they were supposed to be flexible, supposed to align with modern business practice. And there'll be some aspects that we'll look at, especially when it comes to relief for small businesses, for example, that do fit into that category. Certainty and simplicity. Well, we can certainly say the simplicity element. The law itself, while it may seem very, very complex, is actually, in comparison with a lot of jurisdictions worldwide, deceptively simple. I think the idea behind this is really, because this is a brand new concept here in the UAE, is to get everybody on board, start getting used to actually calculating and filing their tax and paying it, with probably then expand into more complexity a little later down the line. Neutrality and equity. Now this is, you can very clearly show throughout the law in the sense that for most businesses, the way it applies is actually it's very sector agnostic. It's very, very fair across the sectors. There's only, as we'll go through, there's only certain types of businesses that really are fully exempt and get away with it, but it applies to everybody else in very, very similar ways. And transparency. And this is the one that we're also really going to look to hopefully see as we progress through the filing of returns and beyond, when it comes to being able to interact with the FTA, who are the administrators for the tax law, and be able to get clarifications, confirmations, and a very transparent tax audit process. So, the first question you'll have is, who does this apply to? I'll hand to Tatiana to pick that one up.
Thank you, Sam. So I think the basic information that has to remain with you after this session is that the UAE corporate tax applies to everyone, to all businesses that are in the UAE. Of course, there are certain exemptions, and we will talk about them, and also incentives. We will talk about them in details. But for all businesses that are incorporated in the UAE, this will be a big issue. So the main businesses is those that are incorporated here, so it's LLCs, any other types of entities with a legal personality, public joint stock companies as well. They are all subject to corporate tax. But not only them, also the corporate tax law applies to certain foreign businesses if they have presence in the UAE. In the corporate tax world, it is called permanent establishment. If certain foreign entity has presence here, let's say in a form of branch, but not only branch, it could be any type of presence, and conducts business activity, such entity will be in the scope of the UAE corporate tax. Also, what can be interesting is that if you have entity outside UAE, but let's say this entity is managed and controlled from UAE, you as a director or you as a general manager, you're sitting here, spending most of the time here, signing meetings of board of directors for this foreign entity. Let's say this entity is in Cayman Islands or Bahrain, where there is no corporate tax. Such entities will be also in the scope of UAE corporate tax. And they will have to register here and pay taxes here. Certain individuals can also be subject to corporate tax if they conduct business activity. We now have this newly released cabinet decision. I guess 2 days ago it was released. The decision clarified that if individual conducts business activity but it generates less than 1 million dirhams throughout the year, this activity will be exempt from tax. And also, as you know, there is no personal income tax in the UAE, so wages, salaries, any other employment benefits, they will not be subject to corporate tax for sure. And this cabinet decision, interestingly and expectedly, also states that investment income and income from rental income will also be exempt from tax if it is generated by the individual. There are certain other types of businesses that are subject to corporate tax, like partnerships, trusts, foundations. How exactly they will be subject to tax depend on their legal status. So the basic rule is very similar to all other jurisdictions. If the entity, let's say it's foundation or partnership, if the entity has the legal personality, then it is itself a taxable person. If the entity doesn't have any legal personality, then for tax purposes the entity should be seen as transparent, and all the proceeds will be taxed in the hands of the owners, settlers, shareholders. Yeah, I think we can move to the exemptions. Some good news that there are certain exemptions and certain businesses that will not pay tax.
Helps if I turn it on. Absolutely. So, while Tatiana will scare you by telling you who is covered, it's my job now to look at who actually will potentially be exempt. Now, I said earlier that there is some very specific exemptions here for businesses. This does apply to most. The law itself applies to most businesses, but there are some that are specifically exempt. Now, really, rather unsurprisingly, government entities, ministries, etc., are exempt. There's a taking from money from one side to put into the other. So government, and also government-controlled and owned entities as well. And for this, it's specifically those that are wholly government-controlled. Also, we see the very long-winded way, we say extractive and non-extractive businesses. That means the oil and gas companies. And the reason for that being, it's not saying that they're going to get away with paying tax on their very significant profits, is that actually they have been one of the businesses that has historically actually been paying tax here in the UAE. So those businesses are currently taxed at emirate level. They all have individual separate private agreements with the government, and they pay taxes through that. And shall we say at a level that may be a little bit higher than the headline 9% rate that's going for corporate tax. There's also some qualifying public benefit entities, qualifying investment funds, and pension funds, and we'll look at those in a bit more detail on the next slide. There's also an exemption for those that are wholly owned and controlled by one of the exempt entities above. So again, it's where you potentially have these exempt groups can actually filter down, so you would actually have the whole group exempt. Sorry, next slide, please. Thank you. So, where you've got investments, often that's done through an investment fund. Now, to actually ensure that the fund itself is not taxable, there are some certain exemptions. There's an exemption if certain conditions are met even. One of those is the fund is subject to regulatory oversight. Also, the interests in the fund are traded on a stock exchange. And lastly, and probably very importantly, the purpose of the fund is not tax avoidance. I mean, those all may seem like fairly simple conditions to meet, but I think this is going to be one of these challenging areas for certain investment funds to look at. But also investment managers. A lot of individuals and companies may use an investment manager that's based here in the UAE to manage their portfolio. One of the things, the risks of that, which Tatiana mentioned, is the possibility that that would give rise to a permanent establishment here in the UAE. So in other words, if they can be based overseas, but if you've got an investment manager here, that could actually mean that you potentially have a presence here. There is an exemption for that. Subject to certain conditions to be considered an independent agent. It generally means that they're actually acting in their own right. They are a completely independent investment manager. They're not part of your business. So it means that there's less of a risk then for bringing that into the tax net. But some of the ones that are actually probably more applicable for a lot of people here in the UAE, pension funds. When you look at public pension funds are exempt. Private pension funds would generally be exempt, again, meeting some specific conditions. A key one of these is regulatory oversight. There's also some conditions around the use of the assets and income of the fund, but generally that's one of the key parts here is this regulatory oversight. The idea is they're not trying to put any sort of tax burden on pensions and savings. A big one for a lot of families that is based here in the UAE is family foundations. So this is your foundations, trusts, that have been set up probably a long time ago to manage the financial interests of a family or group. Now, generally, these would be registered. They'd actually be seen as their own entity, and that would typically mean that they would actually be subject to corporate tax. However, you can apply for that to be treated separately. So rather than tax this foundation, tax this fund, is to actually apply for this to be sort of seen through. So the way it is that it's looked through to the people that are actually underneath it. And the idea being that if they were holding these investments in their own right, they wouldn't actually be subject to tax on that income. Tatiana mentioned this when she said about the taxation of individuals. If you have personal investment income, income from real estate, and you don't operate it as a business through a trade license, that income is not caught by corporate tax. And the idea is to do the same sort of thing for these family foundations. There's a couple of conditions. Has to be set up for the benefit of individuals, can't carry out a business activity, and is just there to manage these funds. It's not there as some sort of avoidance scheme. Okay? Now the big one. The one that I probably get asked about every single day and have done for probably the last year and a half. Free zones. So how does the law apply to free zone businesses? And I imagine some of you will probably have businesses in free zones. The very short answer is we don't yet know. Now, there's a little bit more to it than that. Thing is, it's very well set out that a qualifying free zone person would actually be able to benefit from a 0% CT rate on their income. Okay? Now, there's certain conditions that need to be met. Listed there, I mean, this is around adequate substance. That just means it's not some sort of shell company that you've actually got operations there. It's all very above board. It has qualifying income, and we'll come back to that one. It's not elected to be subject to corporate tax. We'll come back to that one because you thought if you're subject to tax at 0%, why would you elect to be taxable at 9%? There's a few reasons. And also transfer pricing rules, and we will go through that in much more detail because transfer pricing is one of these key aspects that's come along with the introduction of the law that didn't really exist here before. Now, qualifying free zone person, the key one there is the qualifying income. Where it derives qualifying income, that's taxable at 0%. Where it has non-qualifying income, that's taxable at 9%. The big piece of information that we're missing at the moment, which should be clarified in a cabinet decision within the next week or tomorrow, they do like releasing the big ones on a Friday, is what defines qualifying income. Now we have a rough idea of what that's going to look like, and that came from the public consultation document that was released last year, that was as part of the journey. That generally set out that where free zone businesses derive income from within the free zone, that is expected to be qualifying. Again, this is all to be confirmed in the cabinet decision, but this is what was set out in the consultation. If it has customers on the mainland, however, that's where it gets a little bit trickier. Now, the general idea behind this is to try and keep it on a level playing field. So where you don't have businesses that are operating in a free zone, paying tax at 0%, competing directly with businesses that are based on the mainland, paying tax at 9%, obviously have a higher cost base, impacts the profitability, probably have to put the prices up. So it's trying to level that out a little bit. There will potentially be some exemptions to that, sort of passive income, so where you've maybe potentially got a free zone business that is a holding company of a group, sort of dividend income, interest income, this sort of passive investment income would also potentially, and I say potentially, be qualifying income. But we expect clarification on that very, very shortly. Now, one of the key things here is, regardless of whether your free zone business is paying subject to this 0% tax rate or not on any or all of your profits, still needs to register for corporate tax and file a return. So there's still the compliance burden there. It still needs to be done regardless. It just may mean that the actual tax bill is a little bit easier to swallow. But also one of the conditions is that a qualifying free zone business does actually need to prepare audited financial statements. Now, I know that's a condition for being in certain free zones anyway, but others don't necessarily enforce that, but it is now, per the tax law, something that is required. If you're going to have any of your income taxed at 0%, audited financial statements are the way to go. And the reason for this, along with some of the additional scrutiny on transfer pricing, is if you've got an entity that's going to be taxable at 0%, it's a very generous exemption. So they want to make sure that everything is above board. There's very little, trying to reduce the risk that people will be able to unfairly move profits or do anything underhand to try and move things away from tax at 9% to a 0% regime. Okay, what's next, Tatiana? Okay, back to Tatiana to go through the tax rates.
Thank you, Sam. Before we move to tax rates and the calculation of the corporate tax base, I just want to make one step back because I think it's important point. What we see in the practice and what has been happening here for many, I guess, years, is that the business was opening new trade licenses, for instance, in different free zones or in different emirates, without thinking even what is written in this trade license, whether it is a branch or a legal entity or an establishment, sole establishment. There are different variants of what can be written in a trade license. And since the time when the VAT was introduced, I think in the minds of people who is working with taxes here, everything related to VAT was linked to the trade license. We have trade license there, trade license there. But now what we see in many clients have these challenges is that if the trade license, if in a trade license you see that it is an actual legal entity, it's LLC, not a branch. This legal entity, if it even has no office, no employees, even no books of accounts, this is a separate taxable person for corporate tax purposes. So, I mean, it's generally advisable just to revisit what kind of trade license you have and what potential corporate tax consequences it may have if, depending on what exactly is the type of the trade license. If we go back to the basic rules of corporate tax computations. As Sam already mentioned, the corporate tax rate is 9%. Frankly speaking, it is the lowest corporate tax rate in this region, if we don't take Bahrain, because Bahrain doesn't have a corporate tax. So the idea, and it looks like the idea of the authorities was to somehow find a balance between all these requirements of the global tax community, of the European Commission and OECD and all other international organizations that kind of pushed for this corporate tax regime to be incorporated in the here, and being still, attractive jurisdiction for business, for investments. So 9% tax rate, it looks very, very competitive, to be honest. And the 9% tax rate applies not to the whole amount of taxable income. It applies only to the amount that is above the certain threshold. And the threshold is the 375K AD. So everything what is below is taxed at the tax rate of 0%. What is important to understand here is that this is a taxable income. So, this threshold relates to the taxable income. So you need to actually calculate this taxable income to understand whether you are above or below this threshold. And to calculate the corporate tax income, you need to apply certain adjustments. Quickly, if we talk about these qualifying free zone persons that Sam mentioned, covered, it may be the case that the entity in the free zone is considered as qualifying free zone entity. But it may have both qualifying income and non-qualifying income. And if it happens, it doesn't mean that the entity is disqualified from its status. No, it just has two corporate tax base. One tax base will be subject to 0% tax rate, where the qualifying income sits. And another corporate tax base will be subject to 9% corporate tax rate. And this threshold that we mentioned before, 375, it will not apply to this non-qualifying income. So no thresholds are applied for qualifying free zone persons. How the corporate tax base is calculated. For any of you who had experience in other jurisdictions with solid tax, corporate tax legislation, it's very similar. Everything, the starting point is accounting figures. So the calculations will be based on your financial statement. Depending on the level of the revenues that you have, this financial statement should be prepared as per IFRS rules, or the cash basis method can also be used in case the amount of revenues is lower than 3 million AD. It's a good incentive for small businesses because not all businesses, small businesses here in UAE, are required to prepare IFRS financial statements. Then you take this accounting net income and apply adjustments, and these adjustments are quite simple. There is certain types of income that is exempt, certain types of expenses that are non-deductible, certain types of expenses that are partially deductible, and also transfer pricing rules that we will cover in several minutes and in detail. If we go step by step, one more thing regarding the financial statements. It has also been clarified recently that in case, and I think this of course relates to big businesses, large businesses, not the small one, but if revenues are higher than 50 million AD, then this financial statement should be audited. And it doesn't matter where are you, whether it is in free zone or in mainland, this threshold is a signal that the financial statements should be audited. What are the main types of exempt income? So domestic dividends are exempt. I mean, dividends that are coming from UAE-based entity. Dividends that are coming from foreign entities, let's say foreign subsidiaries, can be also exempt if participation exemption rules are applied. I'll explain it in a minute. And also capital gains from the sale of shares. It doesn't matter whether these are shares of local entities or shares of foreign entities. These capital gains can also be exempt based on participation exemption rule. So what is it, this participation exemption rule? We will not go into details because these are quite complicated. I would say one of the most complicated articles in the law. But two main criteria is that you are holding the shares in this entity for more than 5%, and you're holding this 5%, 5+%, for more than 12 months, plus certain other criteria that are mentioned in the law. Then any dividends or capital gains will be exempt. One more interesting point, if your business has presence outside UAE, I mentioned already that legal entities that are located outside UAE, if they are managed and controlled from UAE, they will be subject to corporate tax here. But let's say you don't have a legal entity, it's not a subsidiary, it's just a branch outside UAE, maybe branch in the KSA. Then, if this branch is subject to corporate tax in this jurisdiction, there will be an option to apply for branch exemption. So the income that is generated by this branch will not be taxable here, and you will not be obliged to consolidate this income for your corporate tax base here. I think these are the main types of exempt income. Let's go to expenses. Capital expenditure, obviously and quite logical, are not deductible expenses because you deduct depreciation. If you have some capital expenditures, the expenses that are part of your income and loss statement and part of your corporate tax base will be in the form of depreciation throughout the life of this asset. And it's important to note that there is no specific tax depreciation rules here. So unless we get any clarification from the FTA, and we do not expect to get them, the accounting depreciation should be generally taken for the purpose of your computation of your corporate tax base. Then obviously any expenses that do not relate to the business, it could be personal expenses, it could be even expenses that have a dual purpose, business and personal, will not be deductible for corporate tax purposes. I have to say that for when you have some assets with, for instance, with dual that is used for dual purposes, what it means. For instance, laptop that you use at work and you use maybe for personal reasons at home, or a car that you use to travel for business meetings and also to travel, I don't know, around the UAE. So if we read the law, it clearly says that such types of expenses should be somehow separate, so that you can deduct only the part that relates to the business activity, and the part that relates to the personal usage is disallowed. If there is any type of exempt income, expenses that relate to generating this exempt income will be disallowed. The example could be, again, if we go back to some type of exempt income, you have maybe employees that are working only for the purpose of investing in some stocks, shares, and dividends and capital gains that you receive from these stocks and shares are exempt based on participation rule exemption, then potentially expenses that relate to these employees, because these employees are working only solely for this type of business activity, these expenses may not be deductible. Here is a list of expenses, non-deductible expenses, that you can, I guess, find in any jurisdiction. So I quickly cover them. It's donations, grants, and gifts that are made to certain foundations, charity organizations that are not in this specific list. So we do have a list of qualifying public benefit entities. It was published by the ministry. And if you make your donations not to this list of organizations, then such donations are non-deductible. Fines, penalties. Basically, here what we mean is fines, penalties for breaching the law itself, violation of the law. If these are just fines and penalties that are for the breaching of the contract with your client, if it is clearly stipulated in your contract, then it should be fine and such expenses should be deductible. Bribes and illicit payments, I think no need to comment on that. Yeah, dividends, distribution of dividends. Obviously it's not deductible here, it's not deductible in any jurisdiction, but the important thing here would be to make sure that any types of payments that are made to your owners, shareholders, cannot fall into this category, cannot be seen by the tax authorities as distribution of dividends. Recoverable input VAT, non-deductible as well. I think last point on non-deductibility is that there are certain types of expenses that are deductible but partially. 50% of entertainment expenses are non-deductible, and certain amount of interest expense is also non-deductible, but it will depend on whether these net interest expenses meet certain threshold. So I don't think we need to go to detailed discussion on that, but if you're interested, we can cover during the Q&A session. Do you want to cover small bit? Last point, and I think in this section, and I do understand that this section is quite long, but important, I guess, for some of them, some of you who has small businesses. So it has also been clarified in a recent cabinet decision that the tax authorities, they grant these incentives for small businesses. And if your organization does not generate revenues for more than 3 million AD, then this organization is not subject to corporate tax. This is the basic rule. It doesn't apply to certain types of organizations. First, it doesn't apply to qualifying free-zone person. Second, it doesn't apply to entities that are part of huge multinational enterprise groups. I'm sure you know if your entity is a part of a multinational enterprise group or not, but generally it's a good incentive, and we don't know whether there is a compliance obligation for small businesses to fill in and submit corporate tax returns. Maybe they will be exempt from this compliance as well. Maybe the compliance will be in a simplified manner. Maybe the corporate tax return will be very short and simplified. This is something that was not clarified in the cabinet decision. It is not clarified in the law. The last point is tax losses. I think one of the hottest topics. Everyone is asking what we can do with our tax losses. I think several main points here is that when we talk about tax losses, we talk about only tax losses that are being generated starting from the first fiscal year. So if your first financial year is 2024, then your first fiscal year is 2024. So then only losses that are generated starting from 2024 then can be carried forward for indefinite period of time and can be offset against future taxable profits. I think that's it. I can hand it to you.
Thank you. And I thought it was really interesting that when we're looking at expenses that can't get a deduction for, that bribes was one that came up. And Tatiana moved very quickly on from that one, but I was actually on a panel for a tax event last week, and at the end of it, when you're mingling and discussing with people, two separate people came up to me and asked about the deductions, how you could get deductions through for incentive payments, as they termed it. I think that was a very interesting discussion, and I'm happy to discuss later. But it's one of those that we see all kinds of things going on with businesses here, the way that the business has been done historically, and how that will then interact with the new regime. And I think that nicely leads into this topic, transfer pricing. Now, that may seem like a very alien concept to a lot of people, may not even know what it means. I will explain. But this is one of these things that is going to have a fundamental impact on the way that business is done here in the UAE, whether you're a large business, a family-owned group, or a small business. It will all be the same, and there will be impact on each. So what this basically means is where potentially you have, say, two companies. You own them both, and those two companies maybe have interactions between themselves. One sells to the other, one provides another service. Those transactions need to be at what's termed arm's length. And what that generally means is it's the same basis that you would charge to to a third party, to a customer, to a regular customer. Now, what it's meant to do, really, is to stop manipulation. Because you could start, if you had two companies, you could offer some of these services at a discount. That may mean you're artificially moving profits from one business to another. And as we saw with the discussion around free zones, if you've got some businesses that are taxable at 0% and some at 9%, it becomes awfully tempting to start moving profits in the direction of the 0%. And this is where the basics of transfer pricing come in. Now, what it's meant to do, this actually applies to any domestic and cross-border transactions that you have with related parties. And we'll cover what those are in a second. And also, if you have part of your business that's exempt, part of your business is taxable, any of those interactions, again, need to be at arm's length for obvious reasons. And if you're a qualifying free zone person, there is additional scrutiny around the application of TP, again, to prevent that shifting artificially of profits into the 0% rate. So, when we say related parties, what this essentially means is where there's a connection, and the connection is defined as potentially if it's two or more natural persons. Natural persons are individuals like you and me, not a corporate business. Okay, so they would be connected persons. It's degree of kin. I think it's the 4th degree of kinship, which I think means your great grandchildren and the other way. It's a very extended family, shall we say. So if you're related to them, and they're alive, there's a very good chance that they're going to be a related party. Also, I love the terms here, a natural person and a juridical person. A juridical person is a corporate body, not an individual person. It's a business, or an incorporated body, I think is the term. But essentially, it just means that if you, as an individual, own more than 50% of said company, the two of you are related parties. Okay? Again, if you, as an individual, you own two businesses, you own more than 50% on those, the three of you are connected. You're related parties. Okay? Also, if one business owns another, if it owns more than 50%, if it has that control, again, they're related parties. Also, if you have a permanent establishment, which Tatiana touched on earlier, if you have a business here and you've got a permanent establishment overseas somewhere, again, that is a related party. Now, it's not just based on ownership, because we can see various situations here and in various places where somebody may not actually own more than 50% of a business, but they do exert control over it. So there is actually a specific definition of control when it comes to transfer pricing, and that can include voting rights. So you may only own 20% of the shares, but if you've got 80% of the voting rights, I think the decisions will largely go in your favour. Also, the ability to appoint people on the board of directors would be potentially an element of control. And access to profits is a consideration, and the overall catch-all if you are able to exert significant influence over the operations of a business. And this is targeted at various different ways. Again, it's the way that businesses have been done here, potentially through family-owned groups, for example, where you've got somebody in the family who may not actually own a large chunk of the individual business, but does have a significant say over how it's operated. Again, this is looking at where the related parties would be. It can get a little bit complicated, especially where you've got serial entrepreneurs who own different businesses all over the place. What's the connection between those? Are they related parties? And it's very, very, it requires very careful study to actually look at whether you're a related party. But the key thing is here, where you do have these related party relationships, the transactions, again, have to be at arm's length. Has to be as if you were charging to a completely unknown customer. There's no discounts, there's no sort of behind closed doors. It's all above board. Next slide, please. Now, the one that gets really scary. If that wasn't bad enough, there is this now concept of connected persons payments. So, what this really relates to is it ties into the fact there isn't personal taxation here in the UAE. Okay? So, in other jurisdictions, if you were the owner of a business and you paid yourself a very handsome salary from your business, that would be taxable on you as an individual. Probably wouldn't be the most efficient way of doing it. You wouldn't do that. However, in the UAE, it's tax-free on me. I can get a deduction in the business for this nice salary that I'm putting through. Fantastic. That's a great way of getting the profits out of the business, keeping the tax bill there, and I don't get taxed. This is what this is meant to target. So essentially what it is where payments to a connected person, again, have to be at market value. You have to be able to prove it. So if you were the owner, decide you pay yourself a salary, that has to be in line with the market. You can't just say, well, I'm going to pay myself the entire profits for the year. I mean, maybe that's what it's worth, but it's the sort of thing, and this is where it starts getting complicated. It requires careful study because there is a lot of scrutiny around this. Now, when we talk around connected persons, I mean, we can talk about owners. So if you're the owner of the business, or you have an ownership interest and control. Also, if you're a director or officer of the business, you don't even have to be the owner. If you're significantly high up the management chain, there's consideration there. Also, if you're a related party of one of the above, and also if you're a partner in an incorporated business, you are connected to that as well. So this starts getting wide-reaching. As I say, I don't want to go through too much of the specific mechanics on it, but it's one of these. It's fair enough to say, where you have people who own and operate businesses, this definitely becomes a consideration because I'm sure it's been the practice for a long time. Certain expenses go through the business. There's payments that come out in terms of wages, bonuses, payments for the private yachts, however you want to work it. But this is the sort of thing that then becomes a lot of scrutiny because you're not allowed to then get a deduction for corporate tax for those payments. It's not to say you can't make them, you just won't get a deduction for them. Now, when it comes to disclosure, so essentially you've got to comply with these rules, and there is monitoring to make sure you do. One of these key elements is going to be there's going to be supporting documentation for transfer pricing that's going to be required. So there will be a disclosure form that needs to be submitted with the tax return. It's going to set out various key bits of information related to transfer pricing. For some businesses, we're required to do local and master files, and we'll go that into more detail in the next slide, because I'd say that only relates to certain businesses. But it's important to note that there is documentation requirements for every business, regardless of the size. Also, it's very difficult to try and skirt around not doing this documentation, saying, well, if the tax authorities ask some questions, I'll give them something at some point. The difficulty here is that there's a 30-day period. So if the authorities, if the FTA are looking at your tax return, they think some of these transactions here are a bit suspicious. We'd like the supporting TP documentation, please. You have 30 days to provide that. And for anybody that has had any exposure to transfer pricing, trying to come up with something in 30 days is challenging at best. Also an element here, when it comes to your financial statements, and this is where sort of timing starts coming in, because we'll see as we go later through this, when you actually have to file your returns is a little bit later down the line, but something that does need consideration right now is that potentially in your current accounting period, the one you're in at the moment, by the time you get to the end of that, you actually need to have considered transfer pricing and got all of your transfer pricing ducks in a row, because the closing balance sheet for your last non-taxable period actually needs to be fully at arm's length. It all needs to comply with these regulations. And the reason for that being is it forms the starting point for your first taxable period. And the authorities are trying to make sure that everybody starts off on the same fair footing, that everything is in line with these considerations, that it's all being done. So it is something that actually you potentially need to start thinking about right now, because that is fixed, it's in the law, and there will potentially be scrutiny around this. Last point. So local file and master file. The good news is it only applies to certain businesses. Those with the multinational enterprise group, ones with revenue, I think it's 750 million euros, which at current exchange comes about 3.1 billion dirhams. If your business is doing that, congratulations. But obviously it will mean that you'll have master file and local file to contend with. Also, if you are a taxable person with a revenue in a tax period of more than 200 million, you also need to do this local master file. All it is essentially is it's some additional documentation that your business, your group needs to maintain. It sets out in detail all the transactions that you have with the exempt persons, non-resident parties, etc. It sets it out in a lot more detail. You've got your overall policy and you've got this specific list of transactions that's in there. It can take quite a lot of time to pull this together. Hopefully it won't apply to too many of you in this room, but it's just so you're aware that there are these certain transfer pricing documentation requirements. Even if you don't meet these criteria, you still need to keep supporting documentation for all of your related party and connected person transactions. That's the slightly scary part, because this is something that has generally not been done here in the UAE. You know, we've seen a lot of businesses where there's transactions between, group entities just done on a bit of a verbal basis. There's no documentation for it. There's no support. The price was decided at the drop of a hat. We see all of these things. It's because there's never been a reason not to. There's not been a tax regime. There's not been a particular enforcement of it. And this is why I say transfer pricing is the thing that's going to start having a fundamental shift in the way that certain businesses do business. Okay. Right. Just when you thought you had enough of me, we'll look at tax groups and loss relief. Now, this is actually something that could actually be very helpful from a practical perspective for a lot of businesses. Now, what it essentially means is if you, for example, own five companies in a group, they're all grouped together, maybe they all do slightly different functions, but they're all part of the same group or same ownership. Normally, you'd have to file 5 returns, which is 5 times the effort. What these provisions try and do is, subject to certain conditions, these groups of entities can actually apply to file one single return for the consolidated group. So you can see there's potentially a significant compliance saving there. It's one return, one tax payment. It's all done, wrapped up together. Now, there is also certain benefits to that as well. As you think, if you've got an entity that's profitable and an entity that's loss-making, you might want to try and offset those against each other. If they're part of the same tax group, it all gets mixed together, so you do get that relief for any losses that are there as well. Now, there's certain considerations. Firstly, there has to be a UE top company, essentially the one that holds the others within the group, and there has to be at least 95% ownership from that top co to the others to make sure that they qualify for this group. But if that's the case, then they can potentially go ahead and do this. There are certain businesses, however, that cannot be part of a tax group. Ones that are outside the country, non-resident persons is one. Any of those that are exempt is another. But the one that's the big one is where it's a qualifying free zone business. Now, you may recall a couple of slides ago, when we looked at qualifying free zone businesses, it said there was the option for them to actually apply to be taxable. And you think, why in the world would I want to do that? Potentially, this might be one of those reasons. Because if you've got a free zone business, maybe it's got exempt income anyway, maybe it's loss-making. There could be some reasons why you might actually want to apply to have that treated in the same way as any other taxable business, because you could then potentially put it within a tax group. Again, there's certain practical considerations that may make life easier. However, there are certain pitfalls as well. One of those being, potentially, Tatiana set out that when you look at your taxable income, it's only 9% on anything above 375,000 dirhams. And that applies to each company. So if you've got 5 companies, you've got 5 lots of 375,000 before you actually start paying tax. However, if you're a tax group of those 5 entities, you're one taxable body, you're one tax return, you get one lot of 375,000. So there could be a financial downside as well. It requires careful consideration. There's a lot of other factors that need to be looked at. So just because you can form a corporate tax group doesn't mean you should. And just one point to clarify on that is, a lot of you will potentially be filing VAT returns, and for your entities may actually have VAT groups. Just because you have a VAT group doesn't mean you have a corporate tax group as well. The conditions are very different for both and requires a whole different set of application. So one doesn't translate directly across to the other. I think that's my bit. Oh, loss relief. Okay, nearly the last one. So, say you have entities, you have a couple of entities, again, one that's profitable, one that's loss-making. But, however, you do not have this 95% ownership, you can't form a tax group. It'd be a bit unfair to trap those losses in one place and still tax all the profits in another. So, potentially, if you have 75% ownership, common ownership, then, and there are certain other conditions as well, but 75% common ownership is the key one, is that you're potentially allowed to then transfer losses from your loss-making business to your profit-making business. There's a certain cap on that. You're not allowed to transfer all of it. So if your profit-making business makes 100 million dirhams in a year, you could only transfer losses up to 750,000. Only 75% of that taxable income would actually be allowed to offset for these losses. So there's always going to be some tax that would need to be paid in this situation. That's why it's not as beneficial, potentially, as the tax grouping, but does allow you to start shifting some of these losses so they don't get trapped. Again, it's something to consider when you're looking at this, and it requires a little bit of, with the grouping and this relief, a little bit of forethought, just to look at what the state of your business, your group are, where you have numerous entities, see whether these reliefs are available, and see if there's some, if not, see if there's something that you can potentially do about it. I think that's definitely me now. Okay, Tatiana will now go through the general anti-abuse rules.
Thank you, Sam. Before we move to this section, I just wanted to add several points on the tax grouping. One more situation when you may not want to create a tax group is when you consider the additional compliance burden related to preparation of consolidated financial statement. Because if we look at the rules, IFRS rules for consolidation, they are very different from the tax groups for corporate tax purposes. And in your consolidated financial statement, you may find entities, apart from entities that have a common ownership of less than 95%, also entities that are located outside UAE. So it may be the case that you come up with the idea to create a tax group, but then you look at the consequences of not preparing a separate consolidated financial statement that may even be required to be audited if revenues are higher than 50 million AED. At this point, I think a lot of auditors are very happy. But it should be considered when you're thinking about tax grouping as a kind of blessing. It's not exactly like that. So if we move to this interesting section related to anti-abuse rules, I do understand that people who may not be very acquainted with taxes would find this words quite confusing in abuse rules, but such rules, they exist pretty much everywhere. And the interesting point is that if corporate tax law, the effective date of the corporate tax regime is 1st June, for these rules, the effective date was even in 2022, in October 2022. So in simple words, these rules mean that if taxable person is planning to conduct some arrangement, do some transaction, and even if this transaction arrangement happened in 2023, so the year which is the year prior to the first fiscal year, such transaction can be challenged by the FTA. And any transaction that may happen in starting from the first fiscal year may also be challenged if the tax authorities would see that this transaction, the purpose of this transaction was to avoid taxation. So what could be such transactions? It could be a potential restructuring of your business. You may think about transferring assets from one entity to another. You may think about splitting business into multiple small enterprises in order to avoid taxation, because each enterprise is not meeting the threshold of 375K, or any other types of smart restructuring. It may be easily, very easily, recognized by the tax authorities, because what we see in other jurisdictions, there's a huge tax practice and case law related to such issues. So be mindful that every transaction, every business decision that is taken by you should have commercial purposes and should not have the tax purpose as the main purpose or one of the main purposes. This maybe just to add, that means that it doesn't mean that you are not allowed to change your business and how your business works. This is a pretty normal practice to think about, to expanding business, or to think about whatever, setting up a new entity in free zone. It's fine. From the practical perspective, the question will be, how will you justify it, how you defend your position, and what documents you will have to present to the tax authorities when they start asking questions. And they will start asking questions in a 5 years' time. They will not start tax audits earlier, and you have to maintain all documents for at least 7 years. And in 5 years' time, of course, tax authorities would gather some experience. They for sure know how it is how such things happen in other jurisdictions, and that's why it's worth considering to think about such things now, and to think about tax governance framework, some internal tax policies. Think about how in your business the decisions are made, and what types of documents you have to present to the tax authorities, how these decisions were made. This could be minutes of board of directors or any other similar legal documents. Since we started talking about documents, I think this is the last part that we are covering today. So if we just think, what are the next steps? In several days there will be 1st June, the first effective date. What does it mean? So for your business, your first fiscal year is your financial year, which starts after 1st of June. So if your financial year is from January to December, So your first fiscal year is from January 2024 to December 2024, meaning that you don't pay taxes from the profits generated from 1st June to 31st December 2023. You are paying taxes starting from your first fiscal year. As I mentioned, the corporate tax rate 9%. We already know that the registration for corporate tax purposes has started for certain businesses. It was announced that starting from 15th May, so it is last Monday, pre-last Monday, the legal entities such as LLCs and public joint stock companies, they were welcome to register to get the tax register number. This will be a different number from your VAT registration number. All other entities that are not in these categories, they will be welcome to register at the later stages. Currently, the FTA, they launch weekly sessions on this registration procedure, and they explain how on Emaratax is a new portal, how you can easily register, what types of documents you have to provide, what kind of information should be provided. Very insightful sessions every week. I think next session should be on Wednesday, next Wednesday. So check. I think it should be valuable for every business. But there is no rush in terms of registration, because there are no penalties for late registration, and the basic rule is that you have to register before your first submission deadline, and the deadline for submission of corporate tax returns and payment of corporate tax is 9 months after the end of your first fiscal year. So again, with this example, if your first fiscal year is 2024, then in September 2025, you will have to submit corporate tax return and pay tax. I mentioned already 7 years, that all documents have to be maintained for 7 years, but if you know what has happened with VAT, and the tax authorities this year, in the beginning of this year, tax authorities, they prolonged this period during which the tax authorities can start tax audit for VAT purposes. So initially it was 5 years, and they extended it to additional 4 years. So now there is a 9 years period for tax authorities to conduct VAT audit. That means that 7 years is really minimum period. It might be the case that in 5 years' time we will see that tax authorities extend the period for corporate tax audits as well. I guess Sam has covered TP, master local file. You wanted to add something? There is a good option if something is not clear in the law, and there are certain gray areas, and actually there will always be such certain gray areas, different interpretations of certain clauses. You, as a business, you can apply for private clarification, and this will be open starting from 1st June. You can apply to tax authorities. Of course, it should be like written, properly written application explaining your particular case or particular transaction for which you need the clarification, how exactly it should be treated for corporate tax purposes. And then most probably tax authorities will provide you with the detailed answer. Sam mentioned certain types of businesses that are exempt from corporate tax, and some of them are also exempt from corporate tax registration unless they conduct business activities that are subject to corporate tax. So government entities, government-controlled entities, these entities that are engaged in extractive and non-extractive business, and I guess also individuals that do not conduct business activities. They do not need to register, just logical. yeah, I can handle it to you, Sam.
Thanks very much, Tatiana. And I'll say very well done to everybody so far, because you all appear to be mostly awake, which I'm aware after a good hour of tax is beyond most people. So look, I won't keep for too much longer, but I think just to sort of summarise a couple of sort of key thoughts and the key questions that generally we've been having with our clients, and also a lot of them have been asking us as well. Now, the first thing really for you to consider, to take away from this, is the application of the regime itself to you and your business. Firstly, does the scope of the UACT regime apply to you, to your business? Are you caught by it? Tatiana set out which businesses, which entities are caught. Have to give some consideration. Are you going to be within that tax net? Also, when's your first taxable period going to be? So again, we've set out that your first accounting period that starts on or after 1st of June this year. So again, as Tatiana said, if you're a 31st of December year end, your first taxable period is going to start from 1st of January 2024. And also then, what do you need to do to register? So the portal itself is open for certain businesses, and we expect that to continue to widen over the next year or so. So businesses are going to need to start looking at registration, whether that's something you do now or look to do something later down the line. But again, it does need to be registered before you can actually file your return. And given that we've seen with VAT, with the tax portal, I think it's one of those things to start giving. Don't leave to the last minute is probably one of the things I'll say with that. But then also the structure of your business. So I've established that you're taxable. Let's see how established it applies. It's like, okay, how will this apply? Within the way your business is set up, is there a way to mitigate some unnecessary tax risks? Are you putting yourself in a worse position than you really need to be, just with the way that your business has historically been set up? Some things you've never had to consider before. We've seen things like transfer pricing, for example, but also your structuring of your group. Is there a way to actually look at that and say, I need to tidy this up a little bit to make sure that I'm not paying more tax than I really need to? Also, look at your group. Are there free zone businesses in there? Do you need to look at which elements of income are taxable, that are not taxable, where there's some bits that you may need to change? It's all very important to actually start looking at these things. If you're looking at these things 2 weeks before you file your tax return, unsurprisingly, that may be a little bit late. So the sort of discussions you really need to start having internally, looking at as part of your business now. Transfer pricing we've covered. We've gone through that in detail. Say, do you have a robust transfer pricing policy in place? I'm going to guess that the answer to that will likely be no for an awful lot of businesses, again, because it's not really being required. But it is something that is now going to be required and really needs something to focus your attention, given the fact that there's actually a timeline on that. And then again, this point around payments to connected persons, to the owners, directors, etc. Have you got enough documentation to support the size of those payments, to make sure that you're not going to have any issues getting a deduction for tax purposes for those? When it comes to your expenditure, so Tatiana went through the types of income that you will have in your business that you may not actually be able to get a deduction for. For example, when it comes to interest, there are certain restrictions around that. Maybe you need to look at how you change your funding model to actually make sure that you're not potentially going to have some issues when it comes to getting deductions for interest. Also, there's some other elections, some other quite interesting elections you can make to sort of play with your taxable income a little bit. And again, that depends upon the nature of your business, how that's set up. There's a lot of things that actually need to be looked at in a little bit of detail to see, are you in the best position that you could be when you actually get to the point of filing your return? We've talked about tax grouping. Are you able to take advantage of that? Is that something, not just because you are able to, should you take advantage of that? Is it right that, is it going to be better for you to form a tax group or to not form a tax group? And this is where it comes to looking at both from a financial and a practical perspective to say, is this the right way to go? And there's quite a lot of considerations to look at there. And the last one on here, I would say, financial accounting. The starting point for all of this, how you calculate your tax, comes from your financial statements. Do you currently have the right data systems in place to actually give you what you need? Do you currently prepare entity level financial statements? which would be potentially required. Yeah, what are your requirements when it comes to the accounting? That's the fundamental starting point. Do you potentially need to look at some of your accounting policies? Are there some things in there that maybe you need some tweaking to actually, again, make sure that you're not paying more tax than you really should be? And this is where it's carefully looking at some of these aspects while you have some time to do something about it. And again, that last point I said about transfer pricing with the timeline, your balance sheet at your last non-taxable period. So again, if you're a calendar year end, that's by 31st of December this year, your balance sheet needs to be at arm's length. You need to have done the transfer pricing stuff. And that's why, I mentioned that's the bit that's a bit scary, because that really does have a time limit on it. And it's not something that's 2025 when you need to file your returns. It's something you need to really consider now. And I think the point that goes across the bottom, you can see that there's a lot of things that we discussed today. There's a lot of questions on there, some of which you may be thinking, oh, I know the answer to that, some of which you won't have a clue. The thing is, how will you make sure to address these that your business has access to the right tax expertise? Whether that's through bringing people in, hiring tax professionals to work within your business as part of your finance function. Whether that's through speaking to external advisors such as us, to speak to the experts, leverage that view. Whether it's somewhere in the middle. Again, it's the sort of things you need to be looking at, because there'll be an awful lot of questions, an awful lot of things that have come up today where you're thinking, I'm not quite sure how to really go about tackling this to make sure that when I get to the point of filing my tax return, that I don't find myself in a bit of a disaster. So that's the fundamental point there, and I think I will say thank you very much to everybody. I think at that point we will open up the floor to a Q&A, and say thank you very much for your time today.
Thank you.
I think we've got a question down the front.
Thank you, that was very interesting. In a free zone situation where you've got qualifying and non-qualifying income, you need to allocate your profits. What mechanism do you use to identify cost of sales, which expenses relate to one or the other type of income?
No, absolutely great question, and I'll say that fits into the category of ones we don't have the specific answer to. This will be when we get the cabinet decision that actually sets out what qualifying income is in relation to non-qualifying. There is the expectation that there would be a clarification around this. If there isn't, we could take a view based on certain other elements of the law in terms of apportionment based on revenue. But again, we would expect there to be a level of clarification around it, the exact mechanism for setting out where the cost base will sit alongside the taxable and non-taxable revenue.
So hopefully that will cover things like cost of sales, because
Absolutely.
Qualifying income may have different cost of sales associated to it.
Indeed, and that's very much the expectation. From a practical perspective, there's got to be some clear guidelines in how to calculate that. So that's what the expectation is for the cabinet decision that should land very shortly.
May I ask one more question, please?
Sure.
Payments to connected people. Who is going to say that somebody as a shareholder is not worth $500,000 salary or more or less? How do you prove that, and what sort of evidence do you gather?
There are certain methodologies for calculating this. There's sort of benchmarking exercises that you can go through. I mean, it is a very, very valid question, because everything with all these things, it is slightly subjective. But there are certain mechanisms that have been put in place, certain transfer pricing practices that are very well established globally. Bear in mind that the UAE transfer pricing guidelines are, they're set up alongside, in the same way as the global OECD guidelines. So there's a lot of precedent that you can take from other jurisdictions. However, you are very right in the sense that there's got to be a certain amount of sensibility when it comes to this. And I think for me, it's as long as you are able to comfortably justify the size of this expenditure. You couldn't just go, well, a million dirhams was what I fancied that year. As long as you can actually back it up with something that where somebody looking at this could say that actually makes sense as being the right amount, a sensible amount to pay, then that's what where the burden of evidence lies.
Thank you.
No problem.
Good evening. For a small business owner with 2 or more companies and drawing salaries from both the companies, can there be an issue in terms of taxation? For example, we just mentioned that there should be a market rate at which the salaries are being drawn by a business owner. It has to be at the market level. So in both the businesses making profits, the same entity is drawing salaries from both the businesses. So as an individual, the profitability is getting sucked out of both the companies. So can that be an issue while calculating the taxes?
Did I understand correctly that it is drawn by the individual, right? So the individual is the owner of these two businesses.
Of both the businesses or three businesses.
Yeah, I mean, I think it's fine if the individual is employed by each of the entities, so that you have the document based on which you are paying salary and of each entity, because I guess here in the UAE you can have a co-employment, so the individual can be.
I'm not talking about the employment.
But you
I'm
said
talking
salary.
about the sole ownership, sole proprietorship. You do draw a salary from your own business, right?
You draw what is the form? What is the legal form? Like, is it the dividends that are drawn, or what is the form? Is it like dividend distribution or just proceeds?
Just salaries. Yeah.
Yeah.
I think that question is going to come again and again, because most of the SME businesses owners, they have used, since there's no income tax here, the profits out of what salary should I give myself or how much should I give myself has never been in question. If my business was doing well, I gave myself more. If my business was doing less, I gave myself less. While I was typically, as an owner, also the operating manager of that company. It's not just that I'm an investor, right? So most of the SME business owners, they operate as operating managers of that company. However, most have not paid themselves so-called market value salaries if they were professionals in organizations. Now, I think the question is sort of related to that if I have two such companies, where I am the sole owner in two such companies, I'm the operating manager in both those companies, and I have been paying myself salary from both those companies, will the tax authority say, hey, what's going on here? You're paying yourself, for example, 80,000 dirhams salary per month from that company and 80,000 dirhams per month from this company. As an individual, your market value is not 160,000, it's 80,000.
I think the starting point for this discussion is that when you say salary, you mean just some amount of money that is paid.
Yeah, absolutely.
But for tax deductibility purposes, when we calculate the corporate tax base and we look at these expenses and we see, okay, this is salary, what is the document that can justify the salary? If you don't have a labor agreement, it's not a salary, then it will be recognized by the tax authorities as dividends, so they will...
Yeah, so now this is actually bringing me to another question, which is sort of not with two companies, but we said that any business which is more than 3 million revenue, right, will be, so SME businesses can be, or many can be above that mark here, and most of those owners, let's say, have been paying themselves, you're right, that whether it's called salary in the statement or whether they've been paying themselves something monthly, let's say from that, this as the operating manager. If, what I understood from there is owners, money given to the owners has to be some kind of a market value assessment of that. Otherwise, I can pay myself the entire profits and have no profits to tax, right? Or, so that sort of an assessment, if I have been paying myself a very low salary to keep the profits in the company for reinvestment, let's say for the last 5 years, should I be increasing that in this year and not be falling under the anti-abuse laws next year, saying that how did your salary suddenly jump from 40,000 a month? I was underpaying myself, right?
No,
but
I just want to say
from
that...
the SME business's point of view, this is going to be the most important issue because most owners are operating managers. They are not just investors there. right?
So I
And
just
they've
want,
been underpaying themselves.
so I just want to divide it into two comments. If we talk about the deductibility, the entity may deduct, let's say, salary, if it can justify, confirm that this is actually salary and it is not something else. So if you call it salary and to deduct it for corporate tax purposes, there should be a labor agreement in place. And yes, if this is salary paid to some connected person, not only the owner of business, but I don't know, maybe the wife of this owner or children, then this benchmark study that Sam mentioned should be made so that you have to make sure that this salary is of market level, which is a difficult exercise, I agree. But if you just proceed and you distribute something, it could be in any form, it could be even not in cash, it could be in kind form, to your owner, it may be seen by the tax authorities as dividends, and dividends are never deductible. So there will be even no question about whether by these payments you can decrease your corporate tax base. You can look at the definition of dividends now in this explanatory guide that was issued like 2 weeks ago. It's very, very broad. And of course, if you have never paid such high salary, but you start paying much higher salary in the first fiscal year, the FTA would ask this question, and they will also check this, like the proportion of what was paid to the owner, what is the proportion to the profits. I mean, it's quite easy to justify that these payments are, by its nature, in its substance, are not salary. These payments are dividend distributions. If you want to add something.
I think it's a very comprehensive technical view there. Just I think a couple of it from a practical view. I think the comment around the two businesses paying the wages, when it comes to the support for the amount, and this applies to whether you get one wage, two wage, three wages, etc. There's a mechanism for calculating that. There are set out transfer pricing calculations, and it comes also partially down to the economic benefit that is actually being generated by you as an employee. So if you are splitting yourself, if you're completely focused on one business and you're only drawing a salary from one business, then all the 100% of the economic value is going through that business. If you've got 5 of them, then it's 20% or potentially maybe more in some and others. It's these sort of factors. I'm not saying that's the exhaustive one, but there's certain factors along these lines that go into calculating where that economic value sits and what would be justifiable for the salary. If you've got 100 businesses and you're spending 1% of your time, but you do have a very valuable function, you need to look at what the percentage is there. I hope that answers that question in a little bit of a manner.
So, sorry, just one more here. Companies which are less than 3 million revenue, do they need to register at all, or they don't need to register at all?
So it looks like they have to register, but regarding as I mentioned, regarding the compliance, the preparation of corporate tax return, this is currently unclear, because the FAQs, they mentioned that there will be simplified compliance, but when the cabinet decision was issued, the cabinet decision didn't tell us anything about the compliance burden for these small businesses.
I think the short starting position is very likely that you'll have to register, but as Tatiana said, what you actually have to submit and what you have to do in terms of the paperwork should actually be an awful lot easier than actually having to fill in a full return.
Just to add, the small business relief is something for which you apply. So yeah, I agree. It's most likely you have to get registered and you have to apply to the FTA, present all the relevant documents that the FTA requests, confirming that your revenue is not higher than 3 million AED, and then you have this small business relief. And also, if let's say if in 2024 your revenue is higher than 3 million, but in 2025 your revenue is lower, then you cannot get the small business relief in 2024. 5, because this business relief means that your revenue is lower than 3 million AED in the first fiscal year, in the second fiscal year, and the third fiscal year. This relief is given until, I guess, 2026.
It is worth mentioning there that the small business relief, as it's written at the moment, is a temporary relief, only up till the end of December 2026. So it's not something, at the moment, not something that would be permanent. Sorry, I think there was a question down here. We'll get to you in a moment. If we get the microphone down here.
All right, let him go.
Sure, go for it.
As a startup founder, I'm foregoing my salary for who knows how long. So I want to know if I can accumulate that as a liability to the company, and then when the company raises money, becomes profitable, that can eventually be a tax deduction as a lump sum payment to me as a founder.
That's a good question, and I think it comes down to then how you account for that. Because if you say you're not taking it, it's a difference between not taking it and not being, sort of not accounting for it. So if you wanted to keep the cash in the business, potentially, but you did want to potentially get a deduction, for accounting purposes, you could look at putting this through as a wage for you, assuming that obviously you do the benchmarking and it's the correct value. But for cash purposes, it's there it's still there it's owed to you on the balance sheet. It's not been paid out yet. So that could be something again that you would potentially look at. So if it's just a case of keeping the cash in the business for cash flow purposes, but you're still paying yourself and you can take it out later. Again, this is what I mean when I said the point around looking at some of your accounting policies to see if the way that you've been accounting for things, actually maybe there's a slightly better way of doing it to help yourself in these positions. Because it's not been something you've had to consider before, but could be in this situation something that you could actually look at. Again, it needs a little bit more careful study, but that's a very high level view on that.
But if I were to pay myself a lump sum, let's say after a year, would that be counted as a tax deduction?
Well, it depends. Again, it all comes down to the accounting. So if you didn't take the cash out, but you put it through the books. So for 5 years, you put through 100,000 dirhams, for example, and so you'd have 500,000 deduction. So you'd have 100,000 each year, but you never actually took the cash out. You could then take the cash out at the end of year 5 because you're owed it. It's already been accounted for. It's already gone through.
Okay.
If you see, that's the difference between what you do for accounting purposes and then actually what you do for taking the cash out.
Okay, gotcha. Makes sense. Thank you.
Okay, I think there was a question that chap just over at the back there first.
It was just a quick one, because I think earlier you mentioned there was a 1 million small company exemption, and then there's a 3 million. Is just some clarification on that?
Sure.
Is it 1? Is it 3?
So the 1 million actually is the one for individuals. So if you are an individual, a person, and you run a business, so in other words, if you don't do it through a corporate body, you've not got a company, you just run that as you, that the 1 million applies to that. So if you've got profits of a million, below that, it's not taxable. Okay? You know, if that makes sense. The 3 million is relating to corporate bodies. Say again, sorry? The 3 million is a different one. It does relate to revenue.
But in this case, you're talking about profit.
The profit one is for the individuals. That's what the million was just for individuals. The 3 million is for your corporate bodies. Is a different relief entirely.
Yeah. And just to complete, so suppose a small business enterprise has a profit of 700,000, but the revenue is 2.9 millions. In this case, although from the previous arrangement above the threshold of 375,000 dirhams, you should pay the tax. Thanks to this second setup, you don't pay it.
That's what the aim of this is. Essentially, you have no profit, no loss. It's just treated as a zero.
Okay, good. Thank you.
Hopefully that helps.
Maybe just to add on individuals, many individuals, they run business through sole proprietorships. These sole proprietorships are, again, like transparent. They do not need to register separately because everything is taxed at the level of individual. So even if individual is running business through sole proprietorship, but again, we have to check. I think the 1 million is also revenue. Okay, profit. So 1 million will apply, the 1 million threshold will apply to this structure with sole proprietorship as well.
Sorry, who was next?
Yeah,
Oh.
I have just a question related to transfer pricing and about the common cost sharing. We have a free zone company which operates like an head office, and we have 3 mainland companies. So our thousands of invoicing happens during the year, and maybe 10,000s of items goes to mainland companies. Currently, we are doing at cost. And now each and every item, how we can calculate the transfer pricing, as the benchmarks are not available. There are unique products, and this is related to difficulty we will face in transfer pricing documentation. Or second question is, we are in free zone, we are head office, like we have common departments, HR, accounts, warehousing, and many other expenses. How we can charge those expenses to these 3 mainland companies? Should we invoice them, or if we invoice them, whether we have to add profit on that? Again, transfer pricing matter comes on that question.
Oh, absolutely. And if you don't mind, I'll take the second question first, because it's probably the easier one to cover. So yes, where you've got a business that has, and this is very, very common, where you've got centralized functions, you'll have one company that holds the finance team, HR, all of the back office support, and it's provided, all of the group companies can benefit from this, which I think is the situation you're setting out there. There is then the requirement to recharge that. And that should be invoiced, it should be documented, to be able to provide that support, because you think it's got to be a two-way transaction. In one entity it's going to be deductible, and in the other one it's actually going to be taxable. So in both you need to make sure that you can show, that you've got to be able to have that support to show that it's been done correctly. When it comes to the pricing of that, this is then where the benchmarking comes in, because there would need to be an element of potentially of profit added in, of markup, because of the fact you're supposed to be pricing this as if you've been providing that to an unconnected third party. So there are certain mechanisms for looking at what percentage of markup you would need to add to the costs when you're recharging those down to another company, if that answers your question.
So we should charge profit on the activity which is not our main activity, it is corporate services.
For these recharges, as I say, this is where you would look at when you're doing the transfer pricing study, is whether there needs to be a markup and how much that needs to be. With each, you need to look at each element. This is where it's not always sort of a simple yes or no, do that, it's at that percent. This is where it starts getting a bit more complicated, and where sort of generally sort of it gets quite specialist, is what the function is of that service that you're recharging. What value is it giving to the customer? How is it based? There's various mechanisms that we looked at to establish what sort of markup you would need to put on that. Generally, there is a markup, a profit in your case, that's added to these, but how much and what you actually do it on is where you need to do the study for transfer pricing to look at these elements.
Is it to be done at item level? Each and every item we have to find out the price?
Well, I think for the cost recharges, where it's the head office functions, etc., there is various ways of apportioning that. So it's not done necessarily on a per item basis. And again, without wanting to go through your specifics in terms of every detail, it does require looking at in detail, looking at studying to see where you actually need to do this. And this is why it's key to start considering these things now. You can see from the transfer pricing for every business is going to apply in a very different way. There's going to be each one of you operates in a slightly different manner. You're going to have these little quirks, and because this is something that actually is a time pressure, that you actually need to do it by the end of this, probably likely to be this current accounting period. This is where you need to start asking these questions, actually doing something, because it's not a quick exercise that you can do, a week before the end of the accounting period and go, oh, we need to do our transfer pricing. I'd love to be able to give you a nice straightforward answer, but as we're established, tax is anything but. I think we should be able to send something around.
Yeah.
I think we could be able to obviously coordinate with the TIE guys and see what we can circulate around the group. I think there's a question at the back.
There. Well, thank you very much for this presentation. It's very informing and very confusing at the same time. But so I have 2 questions. One, Tatiana, you said that as a business owner, now the normal practice in Dubai has been the business owner works for his business, doesn't have a labor contract, doesn't have anything. Now a lot of them even have a golden visa, so they have literally no connection with the business on paper other than the shareholding. but they are continuing to draw salary. So you're saying that the business owner should get a labor contract put in place?
That's a good question.
You can't,
and
as far as I know.
I do understand that we can expect some clarifications because there will be a lot of questions around that, and the FTA and ministry, they have to provide some clarity on that. Because, looking what is happening in other jurisdictions, you always need to have some documents to support your expenditure. And what can be other document apart from labor agreement to support the salary? I mean, maybe you know better, but I cannot come up with such document. It can be only the labor agreement, or maybe the letter, but it's now we are coming to a more like legal legal area. I understand for sure, so being a tax consultant, I understand that there should be a legal document that is a base for this salary in order to deduct it. Otherwise, I would see it as quite a big risk that tax authorities would look at it not as a salary, but as I mentioned, as a dividends.
So a board resolution would suffice, in theory.
Both what? Sorry.
A board resolution.
Board resolution.
To pay
I think you're potentially straying into areas where you may actually contravene labour laws. If you're putting something through that you're calling a salary, and you're trying to take a deduction for this as a salary, but you have absolutely no legal paperwork for the employment, you may actually get the tax deduction, but you may actually be causing some problems for yourself elsewhere. Okay. It's one of those. There's got to be a balance. If the amount can be justified, then in theory there should be a tax deduction, but you could be putting yourself in trouble with the Ministry of Labour.
Okay. So I do have one more question. Yeah, So I do have one more question.
So we'll come back. Sure.
So holding companies whose function is just to receive dividends and potentially just earn interest income, how will that work for tax purposes?
So dividends would be exempt. It would be exempt income. So any expenses related to exempt income cannot be deductible.
Okay.
So just to clarify, that's UAE dividends.
Yes.
Yeah, domestic dividends. If we're talking about domestic dividends, then any expenses related to this business activity cannot be deductible. So, I mean, you can deduct your expenses if they correlate to some income-generating activity, not just income-generating activity, but activity that generated taxable income. This is one of the basic rules for deductibility of expenses. So if your income is not taxable, then such expenses cannot be deductible.
So is interest income taxable?
Sorry, interest?
Interest income.
Yeah.
Income is, okay.
Yeah.
Thank you.
Okay.
No, it's not a question. Mine is an answer. No, to me, of course, what I heard is very right. Most of us, we have golden visas, so we are not employed. But it's very important what you said about documentation when you pay out. So the easy way is to create a professional services agreement between the individual and the company. So this is signed, it is specified the amount, payout, duration, terms, condition, when it's ending, when jurisdiction applied, and so on and so forth. So this person who can be the managing director of a company is owning, but since he's not only owning, but he's also working on the company, he get paid, maybe he can raise a debit note to the company, and it get paid every month, whatever it is established, at a reasonable rate, which is market rate. So easy.
Absolutely. I think this, because we've been talking a lot around taking things out as a salary, but you can also have consultancy fees. There's other ways, exactly this, of taking money out. The thing is, the consistent thing with all of them is you have to be able to justify the amount. So the mechanism for it, absolutely, as this gentleman sets out, you could have these various different ways of doing it, whether even if it's not as a salary, but it's the amount that has to be justified, and as long as you're not tripping yourself up with any other legal implications. So thank you for that.
I'll just add that to my mind, this for the individual, these this income, whatever this amount that individual generates through this service agreement, it will be business activity. So in case you reach this threshold of 1 million AED, then it will be taxable business activity for individual. So I think we have to be careful here so that it doesn't fall under the category of business activity. And I just want to make it clear, because I just found that for the individuals, the correct definition is they use the term turnover, and the turnover means the gross amount of income derived during a calendar year, gross amount of income. So I get all the types of income generated by individual will be in the scope of this cabinet decision.
Yay.
I think I'm off.
Let me relieve you as well a bit. Thank you so much for attending. Can you go back to the slide where you have contact details? Because I'm sure everyone wants to connect with you after this. I know we have lots of information to digest. This is just the beginning. More updates gonna come from the government, and I suggest that you get in touch with the experts as well, just to clarify the topics that you have in mind and just to get connected. Yeah, perfect. This is the slide. Thank you so much, everyone, for attending. And also follow Thai Dubai, as mentioned, on social media. We have regular events like this, so this is where you can benefit and get some knowledge for your business. Thank you so much. Have a good day.
Thank you for your attention and for your questions.
Thanks,
it was a
everyone.
pleasure.